You open your bank app, not because you need to buy something, not because there's an emergency, just to check, to make sure everything is still okay. Your balance is there, bills are paid, nothing looks wrong. And yet, there's this strange feeling sitting in your chest. Not panic, not fear, just uneasiness. Because in the background of your life, there's a number you haven't forgotten. A number that quietly follows you around, your debt. It doesn't scream. It doesn't demand attention every second. But it never really leaves either. It's there when you wake up. It's there when you make plans. It's there when you think about your future. And at the same time, there's another thought, a different kind of pressure. If I don't start investing now, am I falling behind? You see people talking about compounding, about starting early, about building wealth slowly over time. And it makes sense. Of course it does. But now you're stuck between two ideas that both feel important. Pay off your debt or invest your money. And the more you think about it, more confusing it gets. Because both options sound smart. Both options sound responsible. And somehow, that makes the decision harder, not easier. Because now it's not about being careless. It's about not wanting to make a mistake. It's about not choosing something that your future self will regret. And that pressure, that quiet fear of choosing wrong, is what makes this decision so heavy. Most people think this is a math problem, something you can solve with a calculator. Compare interest rates, compare returns, pick the higher number, the dunce. But if it were that simple, you wouldn't still be thinking about it. You wouldn't be going back and forth in your head. You wouldn't feel this constant tension every time you think about money. Because the truth is, this isn't just about math, it's about behavior, it's about emotion, it's about how your brain handles uncertainty. And most importantly, about what you'll actually do when things don't go perfectly. Let's slow down and look at this clearly. Imagine two versions of you. Same income, same lifestyle, same opportunities. The only difference is how you decide to handle your money. The first version of you decides to invest. You've read enough to know that starting early matters. You understand compounding. You know that time in the market is important. So you begin. You put your money into investments. Maybe it's mutual funds, maybe stocks. Doesn't really matter. The point is, you've started, and for a while, and feels good. You feel like you're doing something right. Something smart, something your future self will thank you for. But then something small happens. The market drops. Not a crash, nothing dramatic, just a normal fluctuation. But now, your investments are down, not by a lot, but enough to notice, enough to make you feel something. And suddenly, your confidence shifts. Because now, you're not just investing. You're investing while still carrying debt. Your money is going down in one place, while interest is growing in another. And that contrast, that feeling of losing and owing at the same time, starts to bother you. You start questioning your decision. You start thinking, maybe I should have just cleared my debt first. Maybe I made this more complicated than it needed to be. And even if you don't act on it immediately, that doubt stays with you. Quickly, consistently. Now imagine the second version of you. This version decides to focus on debt first. No investing. No complicated strategies. Just one goal. Get rid of what you owe, so you start paying extra. Not aggressively to the point of stress, but consistently, month after month, slowly numbers starts going down. And something interesting happens. You feel lighter, not richer. But lighter, there's less noise in your head, less background stress, less mental weight. And over time, that feeling grows. Because every payment you make moves you closer to zero. And eventually, you reach it. Your debt is gone. For the first time in a long time, you don't owe anything. And that moment feels different. It's quiet, but powerful. Because there's no pressure, no obligation, just space. But then, another thought appears. What if I had invested during this time? What if I lost valuable years? What if I delayed my growth? And just like that, even this path starts to feel imperfect. And that's the reality no one really talks about. Both paths have trade-offs. Both have benefits. And both can make you feel like you missed something. So the real problem isn't choosing between two options. It's trying to find an option with no downside. And that option doesn't exist. This is where smart people get stuck, because they're not looking for a good decision, they're looking for the perfect one. And in finance, perfection is a trap because it keeps you thinking instead of acting. It keeps you analyzing instead of committing. And over time, that hesitation becomes its own cost. There's something else happening here, something deeper than numbers. Debt is visible. It's tangible. You can see it. You can track it. You can feel it reducing. Investing is invisible in the beginning. You don't feel growth immediately. You don't see daily progress in a meaningful way. It requires patience and trust. And patience is uncomfortable because it feels like nothing is happening. So your brain starts to favor what feels real, what feels immediate, what feels controllable. And that's why, even when investing might make sense logically, it doesn't always feel right emotionally. And that emotional mismatch is where most financial decisions break. Because here's the truth: a strategy only works if you can stick to it. Not just when it feels good, but when it feels uncertain, when it feels slow, when it makes you doubt yourself. And most people don't fail because they chose the wrong strategy. They fail because they couldn't stay consistent with it. Think about that. Really, because it changes how you look at this entire decision. Now the question isn't, which option gives me the best return? It becomes, which option will I actually follow over time? Because the best plan in the world is useless if you abandon it halfway. And a simple plan that you stick to for years can quietly outperform everything else. This is where the shift begins. The moment you stop optimizing for perfection and start optimizing for consistency. Because consistency is what turns small decisions into meaningful outcomes. And once you understand that, this whole debate starts to feel different. Less like a high-pressure decision, more like a personal choice. A choice based on who you are, how you think, how you react, how you handle stress. Because personal finance isn't actually about money, it's about behavior, and behavior is deeply personal. Some people can handle debt without it affecting them. It doesn't bother them. It doesn't change how they think or act. For them, investing early makes sense because they won't panic, they won't overreact, they won't abandon the plan when things get uncomfortable. But for others, debt is different. It sits in their mind, it affects their decisions. It creates a constant background pressure. And even if the math says investing is better, their behavior won't support it because emotionally, it doesn't feel stable. And that instability eventually leads to inconsistency. Which brings you back to the same place, not because you chose wrong, but because the plan didn't match who you are. And that's the part most people miss. It's not about choosing the smartest option. It's about choosing the most aligned option. Something that fits your life, your mindset, your tolerance for uncertainty. Because once something feels aligned, it becomes easier to follow. And when it's easier to follow, you stay consistent. And consistency is where real progress happens. So maybe the answer isn't to go all in on one side. Maybe it's not about choosing debt or investing. Maybe it's about creating a balance, a system that moves you forward without overwhelming you, where you reduce your debt steadily while also investing a small amount. Not because it's the most optimized approach, but because it's sustainable, because it keeps you engaged, because it gives you progress on both sides. And most importantly, because it feels manageable. Because in the end, What matters isn't what looks best on paper. It's what actually works in your life. And that's something only you can decide. You don't usually notice it at first. That quiet shift in how you think about money. It doesn't happen in one big moment. It builds slowly, through small decisions, through repeated thoughts, through that constant question in the back of your mind. Am I doing this right? Because the truth is, most financial stress doesn't come from being broke. It comes from being uncertain. Uncertain if you're making progress. Uncertain if you're falling behind. Uncertain if today's decision is quietly hurting your future. And that uncertainty is exactly what this debt versus investing decision creates. Not because it's complicated, but because it's unclear. There's something almost uncomfortable about having two good options. Because when one option is clearly bad, you don't overthink. You just avoid it. But when both options are reasonable, both are logical, both are supported by smart people, that's when your brain starts looping. That's when you start searching for certainty in a place where certainty doesn't exist. And when your brain doesn't find a clear answer, tries something else, it starts looking for control. This is why some people become aggressive about paying off debt, not just because of the interest, but because it gives them a sense of control. Every payment feels like progress. Every reduction feels real. There's a clear direction, a visible end. And that matters more than we realize, because control reduces anxiety. On the other side, investing doesn't give you that same feeling, not immediately. You can invest for months and feel like nothing is changing. Or worse, you invest and your money goes down, which makes it feel like you're losing control, even if logically, you know it's part of the process. And this is where behavior quietly takes over, because your brain doesn't reward logic. It rewards feeling in control. So even if investing is the right move on paper, your brain might resist it. Not because it's wrong, but because it doesn't feel stable. This is why two people with the exact same financial situation can make completely different decisions, and both of them can justify it, because they're not just reacting to numbers. They're reacting to how those numbers feel. There's also something else happening here. Something that most people don't consciously notice. Debt creates a timeline. It has a schedule, a fixed structure, a beginning, and an end. You know exactly when it will be gone. If you follow the plan, that structure gives your brain something to hold on to. Investing doesn't have that. There's no fixed timeline, no guaranteed outcome, no clear endpoint, just probabilities and patience. And for a lot of people, that feels uncomfortable because humans don't like open-ended uncertainty. We like knowing. We like predictability. We like feeling like we're moving towards something clear. So even if investing offers more growth, debt offers more certainty. And certainty is emotionally powerful. But here's where it gets interesting. That need for certainty can quietly limit you. Because growth almost always comes with uncertainty. Think about it. Every meaningful financial opportunity requires some level of discomfort, some level of patience, some level of not knowing exactly how things will turn out. So if you avoid uncertainty completely, you might feel safe, but you might also slow down your growth. And if you chase growth aggressively, without respecting your need for stability, you might feel stressed and eventually burn out. So again, you're not choosing between right and wrong. You're choosing between different types of tension. One is the tension of carrying debt. The other is the tension of uncertainty. And the goal isn't to eliminate tension completely, because you can't. The goal is to choose the kind of tension you can handle without breaking your consistency. Because once consistency breaks, everything else follows. Let's go deeper. Because there's another layer to this, something that isn't obvious at first. But once you see it, changes how you think about money entirely. Most people treat money decisions like isolated events, a one-time choice, a single moment that determines everything. But in reality, money works more like a system, a pattern, a series of repeated behaviors. And when you look at it that way, this debt versus investing decision becomes less about one choice and more about what it leads to. Because every decision you make sets a direction, and that direction influences your future decisions. If you choose to invest while holding debt, you're not just making a one-time choice. You're setting a pattern where you prioritize growth, even while managing obligations. That pattern can be powerful, but only if you can maintain it. Because if that pattern breaks, if you panic, if you stop midway, then the entire system collapses. On the other hand, if you choose to eliminate debt first, you're creating a different pattern. A pattern of clearing obligations before pursuing growth. That can also be powerful, but it comes with its own trade-offs. Because if you delay investing too long, you might miss valuable time. So again, it's not about which pattern is better universally. It's about which pattern fits you. And this is where self-awareness becomes more important than intelligence. Because knowing what to do is not the same as being able to do it. You can understand investing perfectly and still fail to follow through. You can know that debt is manageable and still feel overwhelmed by it. Because knowledge doesn't control behavior. Emotion does. And unless your strategy aligns with your emotions, it won't last. This is why so many smart people still struggle with money, not because they lack information, but because they underestimate themselves, their reactions, their habits, their patterns. They build strategies for the person they wish they were, instead of the person they actually are. And that gap creates inconsistency. So maybe the better question isn't, what should a smart person do? Maybe it's, what will I realistically do over time? Because that answer is far more useful. Let's bring this into a simple example. Imagine you decide to split your money, not perfectly, not evenly, but intentionally. You put some toward your debt and some toward investing. At first, it might feel like you're not doing enough on either side, like you're stuck in the middle, like you're not optimizing. But something interesting happens over time. You stay consistent because the pressure is lower, because you're not forcing yourself into extremes, because the plan feels manageable. And slowly, both sides start improving. Your debt goes down, your investments grow. Not dramatically, not quickly, but steadily. And that steadiness is what most people are missing, because we're often taught to chase intensity, to go all in, to maximize, to optimize. But intensity is hard to sustain, and when it breaks, progress resets. Steadiness, on the other hand, feels almost boring, but it works because it doesn't rely on motivation. It doesn't rely on perfect discipline. It just continues. And in the long run, that matters more than anything else. There's also a psychological shift that happens when you stop trying to be perfect. You stop judging every decision so harshly. You stop second-guessing every move. You stop feeling like one mistake will ruin everything. And that mental space, that reduction in pressure, makes it easier to stay consistent. Which brings us back to the core idea. The best financial decision isn't the one that looks the smartest. It's the one that keeps you moving. Because movement is what creates results, not perfection. And once you understand that, this entire debate starts to feel lighter, not because it's solved, but because it's no longer overwhelming. You don't need to get it exactly right. You just need to avoid getting stuck. And sometimes, getting unstuck is more valuable than being optimal. Because once you're in motion, you can adjust, you can learn, you can improve. But if you stay stuck, waiting for the perfect answer, nothing changes. And that's the hidden cost of overthinking. Not the wrong decision, but no decision. So if you've been caught in this loop, going back and forth, trying to find clarity, maybe the clarity you're looking for doesn't come from more thinking. Maybe it comes from choosing a direction and trusting yourself enough to follow it. Even if it's not perfect, even if it's not optimal, even if it feels uncertain. Because progress rarely feels certain in the beginning, but it becomes clearer once you commit to it. There's a moment that doesn't look important from the outside, quietly shapes how you handle money for years. It's not when you earn your first salary, not when you take your first loan, not even when you start investing. It's much smaller than that. It's the moment you start comparing your life to a timeline that doesn't belong to you, because suddenly, it's not just about what you're doing. It's about whether you're doing it fast enough. You see someone your age investing aggressively, talking about portfolios, returns, long-term wealth, and a thought slips in, am I already late? At the same time, you see someone else who's completely debt-free. No EMIs, no obligations, just freedom. And another thought appears. I should have cleared everything first. And now, you're not just making a decision, you're reacting to what you see, reacting to what you think you should be doing. This is where things start getting messy. Because your decision is no longer based on your reality, it's based on someone else's situation. And the problem with that is simple. You don't see their full picture. You don't see their income, their support system, their risks, their stress. You only see the outcome. So you try to copy the decision without understanding the context. And that's where even smart people start making choices that don't fit them. Let's make this real. Imagine someone earning a decent salary, not extremely high, not struggling either. They have some debt, maybe a personal loan, maybe a credit card balance. At the same time, they're seeing content about investing everywhere, mutual funds, stocks. Start early. Don't miss compounding. So they start investing, even while carrying that debt. And initially, it feels like progress, like they're catching up, like they're doing what they're supposed to do. But slowly, something changes. Not in their bank balance, but in their mind. Every time an expense comes up, they feel stretched because now their money is split. Part of it is going toward debt. Part of it is going toward investments. And there's less flexibility. If something unexpected happens, they feel it more. Because they've committed their money in multiple directions. And over time, that pressure builds. Not enough to break immediately, but enough to create tension. Now compare this to someone else. Same income, same debt. But they make a different choice. They decide to simplify. Focus on clearing debt first. They're not thinking about optimization. They're thinking about breathing space. So they reduce variables, one goal, one direction. And because of that, their mental load decreases. Their financial life becomes easier to manage. They're not growing wealth yet, but they're building stability. And that stability changes how they operate. They're less reactive, less stressed, more focused. And once the debt is gone, they shift. Now they start investing. But this time, with clarity, with confidence, without that background pressure. Now here's the interesting part. If you compare both people after a few years, difference might not be as big as you expect. Because while one person optimized for growth early, they struggled with consistency. They stopped and started. They hesitated during uncertainty. And the other person, even though they started later, stayed steady, stayed consistent. And consistency quietly closes the gap. This is something most people underestimate. They assume the person who starts first always wins. But that's only true if they stay in the game. Because starting early doesn't guarantee success. Staying consistent does. And consistency is emotional, not mathematical. It depends on how you feel when things go wrong, how you react when things slow down, how you behave when results aren't immediate. Which brings us to a deeper realization. Money decisions are not just about outcomes, they're about identity. The kind of person you believe you are affects the kind of decisions you make. If you see yourself as someone who takes risks, who thinks long-term, who can handle volatility, you'll lean toward investing. If you see yourself as someone who values stability, who wants control, who prefers certainty, you'll lean toward clearing debt. And neither identity is wrong. But problems start when you try to force yourself into an identity that doesn't fit, when you try to act like an aggressive investor. Deep down, you're uncomfortable with uncertainty. Or when you avoid investing completely, even though you're capable of handling it. That mismatch creates internal conflict. And that conflict leads to inconsistency. So instead of asking, "What should I do?" maybe a better question is, "Who am I when it comes to money?" How do you react when things don't go as planned? Do you stay calm, or do you feel the need to act immediately? Do you prefer slow, visible progress, or are you okay with delayed results? Do you feel stressed carrying debt? Or can you treat it as just another number? Because those answers matter more than any formula. And once you understand that, you stop chasing the perfect strategy and start building a personal one. A strategy that fits your behavior, your mindset, your reality. Because that's the only kind of strategy that actually lasts. There's also another layer most people don't notice: lifestyle pressure. As your income grows, your life expands. Better food, better experiences, more responsibilities. And suddenly, your financial decisions aren't happening in isolation. They're happening inside a lifestyle that keeps evolving. If you're aggressively investing, while also trying to maintain a certain lifestyle, you might feel stretched. If you're aggressively paying off debt, while others around you are upgrading their lives, you might feel like you're holding yourself back. And both situations create a subtle pressure, not from money itself, from comparison. And comparison is one of the fastest ways to lose clarity, because it shifts your focus from what works for you to what looks good from the outside. And once that happens, your decisions become reactive. You start adjusting your strategy, not because it's wrong, because it doesn't feel right compared to others. And that's dangerous, because now you're not following a plan, you're chasing a feeling. And feelings change quickly. So the real challenge isn't just choosing between debt and investing. It's protecting your decision from outside noise. Because without that protection, even the best strategy can fall apart. This is where the turning point begins. Not in the numbers, not in the strategy, but in how you see the entire situation. Instead of viewing this as a decision with a correct answer, you start seeing it as a system you can adjust. Something flexible, something that evolves with you. Because your life won't stay the same. Your income will change. Your responsibilities will change. Your priorities will change. So expecting one perfect decision to carry you forever doesn't make sense. What makes more sense is building a system you can return to, a way of thinking, a way of deciding, where you periodically adjust, where you respond to your current reality, instead of locking yourself into one rigid path, because flexibility is what keeps you consistent over the long run, and consistency is what turns small actions into meaningful results. So maybe the goal isn't to choose once and for all. Maybe the goal is to stay aware, to keep adjusting, to keep moving, without losing yourself in the process.